Hey everyone, welcome back to My Favorite CPA. Today, let's dive into a topic that could make or break your investment strategy, especially when you think about tax implications. Whether you are a seasoned investor or you're just getting started out, having an overview of how taxes affect your investment and your returns is crucial. So grab a notebook and let's get started. First, let's talk about some common investments, which would be the big four: stocks, bonds, real estate, and mutual funds. When you buy and sell stocks, you're going to be exposed to capital gains taxes. Now, capital gains taxes, it sounds like it could be bad, right? But it's actually a good thing. If you have held the stock the required period over 1 year, then when you sell and you have a profit, it's taxed at a lower than normal tax rate. Now, if you've held that stock for under a year, it would just be taxed at your normal tax rate. Now, next, let's talk about bonds. Bonds are a little bit different. Interest income from bonds is almost always taxed as ordinary income. However, municipal bonds, those can often be exempted from federal taxes and sometimes state taxes, depending on the investment option. It can make it very tax efficient and appealing. Next, let's talk about one possible way of investing in real estate. Now, when we talk about real estate in this sense, we're talking about maybe a personal investment objective and not investor status as an investor who invests in real estate. Now, the great thing about owning real estate under the American tax system is there are some things that can potentially be deductible to you, including mortgage interest, property taxes, and if it's a small rental property, something called depreciation. Now, here's where it really gets fun. For your personal residence, if you have met the criteria by living in that property at least 2 out of the past 5 years, you can sell that property, and as a single individual, you could have $250,000 of gain or profit with no tax. If you're married, the amount could be $500,000 if you meet the criteria. Next, let's talk about mutual funds. Mutual funds can have a lot of tax implications. One interesting phenomenon about mutual funds is mutual funds can have internal capital gains that gets distributed to investors as increased ownership. You don't really get any cash at the time of those capital gains distributions, but you would owe tax. And people think that's weird because you haven't sold your shares. Next, I think we should talk about tax-advantaged accounts. These can be a game changer for your investments. First, let's talk about IRAs. IRAs stands for individual retirement accounts. They really come in two flavors, which would be traditional IRAs and Roth IRAs. There's a lot of confusion around these two. Perhaps I can demystify it for you a bit. With a traditional IRA, you get a deduction today on your tax return. With a Roth IRA, you're using after-tax dollars, so no deduction up front. Both a traditional IRA and a Roth IRA can grow and grow and grow, and while it's growing, in theory, there's no taxes. Now, where they also differ is on the back end in retirement. With a traditional IRA, because you got a tax break up front, anytime you pull money out, you have to add it in with your taxable income, which could cause it in your retirement years to be exposed to some tax. In theory, a Roth IRA, it also grows just like a traditional IRA, but in retirement, when you pull money out because you didn't get a tax break up front, it's supposed to be tax-free. It's very appealing. Next, let's talk about employer plans. This would be something like a 401k or a simple IRA. Similar to traditional IRAs, employer plans allow you to invest pre-tax income, which would lower the amount that you're paying tax on today. However, the same rules do apply, which is in retirement, when you pull money out, it will be added into your taxable income, which means you could potentially pay tax. Understanding tax implications is one thing, but implementing strategies that can help you minimize what you owe is also important. So think about some of these things. First, we have tax loss harvesting. So this is a strategy that you can use to analyze your entire portfolio and maybe get rid of some losers in a year that you have winners, thereby offsetting the gains and the losses and minimizing the tax effects of that winner. Just remember to be aware of something called the wash sale rule, which means if you buy the same stock, you may give up the favorable tax treatment. Next, I want to talk about something that's monumentally important, and that is planning for withdrawals. What we're talking about here is in retirement, or maybe during, certain seasons of life. You should really plan your withdrawals strategically, both with your investment advisor and with your tax advisor. Sometimes there can be unexpected consequences. Some planners will say it's very important to have different pools that you can draw off of, different buckets that are, tax favored, not tax favored, so on, because nothing is worse than being in retirement and having all your money locked up in a plan that you have never paid taxes on. Because if you need a new car, if you need a new dishwasher, it creates a lot of anxiety for retired people because every time they tap that money, they worry about owing tax. Some people make the mistake during their working years of tapping their tax advantaged retirement plans, and that can really undercut your retirement in a serious way. An insult to injury is you can owe more taxes and penalties than you ever could have imagined. So wrapping things up, understanding tax implications of your investments can empower you to make smarter financial decisions. I personally think it's very important to be working with an enrolled agent or a certified public accountant around these decisions in connection with your financial planner. Sometimes, if you make decisions in a vacuum without knowing the consequences, it can have devastating results. But the flip side is, with the knowledge of professional resources, you can make the best decision for your situation. Did you have any questions or topics or something you'd like for us to cover next? If so, drop them down in the comments. Thanks for watching, and for more tax news you can use, follow me.